So in this video, we're going to talk about interest rates and interest rates in relation to consumer credit. So just like you pay rent on things like housing, for example, when you're renting a apartment, you're going to pay a certain amount to your landlord for the right to use that apartment to live in. And in the same way, when you borrow money from a lender, you're going to be paying the lender for the right to use their money. And this rate that you're paying the lender is called interest. So interest is like rent. It is the cost you pay a lender for renting their money. And what do you use the money that you're borrowing from the lender to do? It's to buy a house, buy a car, pay tuition. And so in this way, interest, it's a rate that you're paying a third party for the right to use something. And in this case, it's the right to use their money. Just like the cost of rents in a city, the cost of borrowing money also fluctuates. So it changes from time to time. And so the interest rate is not a stable number. It changes depending on, just like anything else, supply and demand. So, um, the availability of money is variable over time. So when it is scarce, the interest rate is going to be high, and when there's an abundance of capital and money available to lend, the interest rates are going to be lower. So in consumer credit, we have this term annual percentage rate, and so you'll see it abbreviated as APR, and it is a term used in the US for how lenders must quote their interest to consumers. And so basically, the reason why the APR exists is because lenders would often, before the laws required them to kind of quote APR, is that they would maybe offer a really low headline interest rate. Let's say they said, okay, we'll lend to you for 2% a year, but then they would add on a bunch of fees and different costs to the loan to effectively earn more money on the loan than just the interest rate. So even if the interest rate was 2%, if they said, okay, there's an origination fee of 5% of the loan up front, you're going to end up paying, and let's say you paid off the loan in 1 year, you're going to end up paying 7% because you paid the 5% kind of upfront as a fee and then the 2% as the interest. So even though the headline interest rate was 2%, because of the fee, you ended up paying more. So in order to kind of get around these games that lenders were playing, they are now required to quote an annual percentage rate. So you'll most commonly see lenders quote APR for credit cards, mortgages, and auto loans. These are kind of the big three uh, consumer credit products. And just to give you an idea of what the range of this are, so the median credit card rate in the U.S. is around 19% currently, and this 19% though is pretty variable. It is dependent on the card and your credit score. So certain uh, credit cards offer lower rates, but typically you have to have a higher credit score to be eligible for that card. But this is 19% is kind of the median, and that's really high. 20% interest rate is a lot. So if you kind of accumulate credit card debt, you can see why it's hard to get out of that because for every $100 you borrow, for example, you're going to be paying $20 of interest per year, or $19. So that can add up, especially if you're just making payments on the loan, and you don't have the means to just pay it off all at once. Mortgage APR has been around 3 to 5% over the past 10 years, so clearly it's a much lower rate of interest, and the reason why is because it's secured by a piece of real estate. A mortgage, is kind of backed by a house or other real estate, apartment building, whatever it is. So the interest rate drops because the bank has recourse to this particular piece of real estate if you stop paying. And also, mortgages typically have a much stricter underwriting, which means the lender is going to scrutinize your income, and look at your finances in much more detail, because the loans are much larger than just credit card. Because a mortgage, they're going to be lending you, several $100,000, while credit card maybe is only going to be, the limit may be only a couple thousand. So mortgage lenders are typically much more cautious because they're lending much more money. Okay, so let's talk a little bit more about APR. So APR, as I mentioned, is an attempt to standardize interest rates, or rather standardize the interest rate quote, so that a consumer can compare lenders. Because basically, if each lender is kind of has its own way of explaining the costs of their particular loan, a consumer may find it difficult or confusing to compare two different lenders as to see which one is actually a lower overall rate. So the APR was an attempt to force lenders to quote their interest rates and the cost of their loan in a standard way, so that consumers can more easily be able to compare one lender against another. Also, it is intended to inform consumers of what the true all-in interest rate that they're going to pay is. So I gave the example before about the different fee that could be charged at the beginning or the end of a loan, that could add a cost to the loan, but the interest rate necessarily, if it was not quoted in a standardized way, may not reflect. So though the APR is a good attempt of achieving these goals of standardization and for informing the consumer of what the true all-in cost is, there are some flaws to it. So let's just discuss what some of those are. So for credit cards specifically, credit card interest is compounded daily. So that means, let's say the interest rate is 12% a year. That's the same as 1% a month, which is the same as, uh, you know, 1 over 30% a day. So 1 divided by 30% a day. And so basically, depending on how you calculate the interest, this idea of compounding, which we'll have a separate video on, but basically, there's a difference between calculating interest per day, meaning let's say you have a balance of $100. If you charge 1/30% every day, it's not mathematically the same as charging 12% a year. And we can do a different video to kind of prove that mathematically. But basically, so credit card interest is compounded daily, while APR is quoted as a yearly rate that is compounded monthly. So this daily versus monthly compounding does make a difference. So for example, a 12%, a 12.99% APR is effectively 13.87% after adjusting for this monthly versus daily compounding effect. So you can see that the daily compounding adds an extra 0.87%, approximately 0.88%, to the actual cost that you're going to pay. So even though you'd see this 12.99% APR for your credit card, in a year, you're actually going to end up spending not $12.99 for a $100 balance, but $13.87. And so, this is one way which the APR is actually understating the cost for credit cards specifically. So APR for credit cards does not include any fees or charges. So late fees, balance transfer fees, all these types of things are not included in the APR. Mortgage APR also has some noise as to which fees and points are included. So though the mortgage does include many fees, there may be some fees that are not included. So you'd have to kind of make sure you look into detail when getting a mortgage as to what fees are being charged, to make sure that the APR is not kind of misleading you as to the actual cost. Okay, APR is dependent on the loan period, since upfront costs are spread over the term of the loan. So comparing a 20-year mortgage APR with a 30-year, it will not be a totally fair comparison, because For example, if there's an upfront 1% origination fee on a mortgage, for example, a 20-year mortgage is going to spread that 1% over 20 years rather than for a 30-year mortgage over 30 years. So even though the actual dollar amount for the fee is the same between the two loans, the APR for the 20-year mortgage is going to be a little higher because it's not spread over so many years. So I think it'll be worthwhile to do another video to see how interest kind of accumulates over time on a credit card, and how APR kind of works when looking at different um, consumer credit products. So look out for that in the practical videos that will be actually looking at real life situations.